Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing 23andMe stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Usually the day before I do a video, I just go through it. It takes like an hour or so just to make sure I didn't make any errors or if I have to add anything. So I'm doing this video tomorrow. So this is just a prep for tomorrow's video. So feel free to comment. You can talk about other things, but I figured I always do it by myself, the prep. So I'll just do it live and then maybe I'll get more info. So 23andMe is a publicly held personal genomics and biotech company. See right there, I don't like the way that sounds. The genomics and biotech company. It is best known for providing a direct-to-consumer genetic testing service. Again, I don't like the way that sounds. Testing kit. Okay, it is best known for providing a direct-to-consumer. What's up, M. Taylor? It is best known for providing genetic test results where customers provide a saliva sample that is analyzed in the laboratory. Generate reports relating to the customer's ancestry and genetic predispositions. The company's name is derived from the fact that there are 23 pairs of chromosomes in a human cell. Since 2014, it has offered its services to people in Canada and the UK. It has provided 11.6 million people with their genetic tests. So the more people that use the service, the more accurate the data becomes. Hey, Alan, what's up? I hope I make money on these penny stocks I've been buying. I'm gonna look like an idiot if I lose money. The company today, it's was it PBRX? No, it's what was the name of the company I talked about today? Come on. Oh yeah, FBRX. Forte Biosciences. They have more cash on their balance sheet than the market cap. So if they liquidated the assets, they liquidated the whole company today, each shareholder would get like a 30% return on investment if they just sold the business. Plus they have patents. They have 7 patents. The only drug they are working on just failed phase 2 clinical trials. So the only drug that they had will not get FDA approval. So I think the company will probably just sell all its assets. So it seems like just there's no downside. Okay. Its saliva-based direct-to-consumer genetic testing business was named Invention of the Year by Time Magazine in 2008. Hey, Ben. When you use this company's service, you'll be able to accurately identify your family's medical history so you can be proactive and try to fix a problem before it is too late. So if you may know a lot of your family history already, but sometimes you don't realize that there's certain diseases that run in your family. So if you can just be on top of that, maybe take certain medicine or avoid eating certain things, you'll live possibly longer, healthier life. Now, the real benefit, I think the saliva thing and providing people their family history is cool, but I think the thing that can separate this company and make it $100 billion company is the data. They have a lot of data on people's genetics. So right now they're selling that data to GlaxoSmithKline, and then Glaxo is developing drugs to help treat all the diseases this company identifies. So right now it's in phase 1 on one of its drugs, and it's in the preclinical stage for many drugs. So its pipeline has grown from 5 drugs in 2019 to 9 drugs to 19 drugs. Do you think it's a better company? I don't know. Is it Ancestry DNA? Is that publicly traded? You know, when I do these videos, I'm trying to just give the information. Personally, I wouldn't invest in this company, but I'm not saying there's anything wrong with this company. I'm not. I don't know. I wouldn't invest in them. I mean, I can't. It's hard for me to explain, but I'll give all the information, and it does seem interesting. But obviously, in a video, I can't really say that because people like when you pump up a stock and talk really positively. You get a lot better comments and more likes. If I talk like negatively about a company, you get a lot of people get upset at you. Esatino, Joel, what's up? I've noticed that like the videos I try to be honest in all my videos, but when I give the information explain it the best I could, especially if the company's struggling, people get upset at me. They're like, you're wrong. This company's going to the moon, and because they have money invested, so they want me to say only positive. But okay, so 23andMe was funded by a SPAC, a special purpose acquisition company that's formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. So SPAC are really popular, but SPACs have been around a long time. I mean, it wasn't called SPACs. It was just a reverse merger. A public company with deep pockets would just buy a private company. It happens all the time. So in June 2021, the merger was completed, and 23andMe received $3.5 billion in cash proceeds. That's a lot of cash. Usually, when these SPACs acquire a company, it's like a few $100 million. $3.5 billion. That's a pretty big company. Yeah, I mean, I try to like stay in the middle and just give facts, and sometimes I give some of my opinion, but if you give me a company, any company, I can make them look amazing. Like it's a great company. You got to buy the stock. And that same exact company, I can make it look terrible, and it's extremely overvalued, and you should sell the stock. Any company. So that's why you have to kind of like ignore analysts, because you can skew the numbers anyway. Even like Microsoft, you can make them look like a terrible company. I mean, obviously you can't say it's a bad business and they won't go anywhere. But you can make the argument that they're overvalued and you shouldn't buy the stock because it's too high. But anyways, okay. So the SPAC that acquired 23andMe was VG Acquisition Corp. VG is Richard Branson's company. He owns Virgin Group, the billionaire that owns Virgin Group. A great quote by Richard Branson. He said the best way to become a millionaire is to become a billionaire and then buy an airline. That's how inefficient airlines are. So hard to make money with an airline. Although he's doing pretty good with it, and JetBlue is doing really good in Southwest. But outside of those three airlines, they just always lose money year after year. They hardly ever make money. If it wasn't for the government bailing them out, they would all be out of business. So the company is headquartered in Sunnyvale, California. It was founded in 2006. It trades on the NASDAQ. So this is a good idea because I do this anyway. I spend like an hour to an hour and a half. After I prep the video, I didn't go through it just to make sure I didn't miss anything or make mistakes. So I could just do this live. And obviously it's not, it's much nicer in the video because I have everything cleaned up, but let's get started with the model. This is a mid-cap company, 4.8 billion market cap. They're trading at $12 a share and they have 407 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future. That's what we're doing in this video. Free cash flows, cash flow from operations minus capital expenditures. So I don't have really any full year of financial information because they just went public. The only thing I have is so I wouldn't do this in the video, but I forgot what it was. Okay, it's second quarter. The only thing I have is their second quarter 2020 numbers and their second quarter 2021 numbers. So to get their full year 2020 to 2021, I just multiplied that by 4. So this is all estimates. I don't have any accurate data or exact data. So they have negative free cash flow. Net income is the profit or loss on the income statement. It's a revenue minus expenses. That's negative as well. Revenue went from 192 million. So they had 48 million in the second quarter. So I just multiplied that by 4. 192 million in 2020 up to 237 million in 2021. I mean, this is a pretty big company. This is not like a lot of these companies who get acquired by a SPAC are usually pretty small, like under $1 billion market cap. But this company could have went public without the help of a SPAC. That's what you got to remember. When you invest in a SPAC company, you're investing in a company that probably couldn't go public on their own. They just got the help of the SPAC. So I think in the long term, you're going to see these SPACs are not good investments. A majority of the time, they're not great investments because they would have went public on their own without the assistance of another company. That's why a lot of them are down like 70, 80%. Okay, this is the company's income statement. So the top line is the revenue, the sales. It's just the second quarter of 2021 versus second quarter of 2020. They had 59 million of sales. And here's a breakdown of their sales by country. So US is a bulk. It's 2/3 of their sales. 14 million in the UK, 3.2 million in Canada, and 1.7 million. The thing I do like about this company is it's scalable. I like companies that you can scale because you can literally sell to anywhere in the world and you don't really need to do much work besides just getting the test kit in and examining it, which is pretty easy to do. You don't have to you don't need tons of people, tons of staff. You don't need equipment and things like that. The reason their sales are so high in the UK is not because a lot of people in the UK wanted to get their saliva tested to find out the genetics. It's because GlaxoSmithKline paid this company $11 million to get information, because they have a lot of information about people's DNA. So GlaxoSmithKline, in order to develop the drugs, they pay this company. So that's the real scale. That's, I think, the real home run of this company, if it does take off. 780, and I'm 21. Nice. I like Hyliion. AITX, I'm not too sure about. So the way these, a lot of these companies like make money is information. It's not like Uber. They're not selling information. I mean, they do have some data, but they're just driving people around. But like Facebook, Google, it's all about selling their data. Google makes a ton of money on selling ad space. So they have all this information on people, so they know where to put the ads. So that's what this company will eventually do, is they can sell a lot of that information to large biopharmaceutical companies, and they can develop drugs based off of that information. And it's kind of more legitimate if they have all this real data of actual people. I mean, the people spit into a tube and they examine their DNAs. These are real people, and they have it from all over, all over different countries. And then if they can drill down certain segments, you might have Jewish people, Black people, Spanish people, and then different people are more likely to get a certain disease than others, like different groups. Sometimes male and female, there's different diseases as well. So really having that info is just huge. So the more people that use this service, the better the results will be when you get your genetic testing, to see what countries you're from, or your family's from, and to see what diseases your family history is. The better that info will be, the more people that use their service. So pretty much all the research services is from GlaxoSmithKline. I think it's all from them, and they're in the UK, so that makes sense. And the consumer services are the people like me and you who contact the company, spit into a tube, and then find out where we're born or what our nationality is. Can you talk about Sophie? I did a video on Palantir. We could talk about Sophie, but I don't know. I can't really talk too much without putting it together or looking into it deeper. I don't really know. I know of Sophie, but I can't talk too much details about them because I haven't really dug into it. Since I do a video a day, I can't spend more time outside of that one video I do. But so below revenue is, let's see, they broke it up into consumer and research services, adjusted EBITDA, therapeutics, total adjusted EBITDA. So I guess these are the expenses. I think it's mainly R&D, but it doesn't say that. It says therapeutics. So I guess these are all the expenses associated with running their business. It's probably the payroll that you have to pay scientists to research to analyze the DNA. So that's all that comes out of 27 million. Wait, let me look. Let me pull up the 10Q. Sage has earnings tomorrow. This is what I would do when I'm preparing for the video. This is exactly what I would do, because I'm not even sure 59,239. Okay. Oh, this is the income statement. I'm not even sure. Oh, this is not the income statement. Okay, I didn't even pull the income statement. That's probably why. So that's why I prepare for. Why I do this kind of like cold run. So I have all the information for the video. No, I don't own ME. I probably, I don't think I would buy the stock, and it's overvalued. I think it's really overvalued right now. Not just well, my model will say it's overvalued, but I do think it's going to come down. I'm pretty sure it should come down. I think it's way too much right now, but anyways, so 59 million of revenue, right? Okay. The cost of revenue is about half that. So that's all the costs associated with getting the test kits, like actually shipping the test kits out, having somebody ship them, receive them, having a scientist analyze the saliva. It includes a lot of things, depreciation. So they do have positive gross profit, so that's good. But the R&D is where they can eat up a lot of their revenue. So you can see the R&D is more than their gross profit. But as they grow and revenue increases, their margins will improve a lot because it's a really scalable business. Once you have things in place, then you cover your fixed costs, it's all profit. Because a company like Tesla, it's of course their margins would go up as they sell more cars, but it's not as dramatic, the margin improvement, as a company like this, because it takes time and money to build each car. Even if you have a process in place, it still takes a lot of man hours, and there's different things that go on throughout the process. But this is really scalable. There's not going to have to build that much infrastructure to just test more DNA kits. Sales and marketing, which will probably increase a lot as they grow because they want to get more visibility. That was 15 million. G&A actually went down. General and administrative. This is payroll for certain employees, insurance, rent. So they have negative operating income. Do they have any debt? They have a little debt, but there's no interest expense on their income statement. So, okay, so negative net income every year. This is the company's statement of cash flows. The top part is operating cash flow. That's how much cash the company loses from its operational business. And the way you calculate operating cash flow, you start with your net loss, and then you have to add or subtract the non-cash items on the income statement. You also have to adjust for changes in working capital. So you can see they spent $9 million in inventory. That's a cash outflow when you spend on inventory. It's a negative. But when you sell the inventory, when you move it to the income statement, it's a cash inflow. It's a positive. 6.9 million of accounts receivables. This is probably with GlaxoSmithKline. They're probably. I think it's a contract they have with that company, and I think 23andMe gets paid certain milestones along the way. So they'll probably always get a book receivables until I think that milestone or that time period is hit where they receive payment from Glaxo. That's in deferred revenue. That's what I was thinking of. Deferred revenue. So this is when they receive payments for the product in advance. And until they, like if a customer wants to get their DNA tested, say they pay $50. Well, the company receives the money, but it's going to be another week or two till they actually analyze the person's saliva and give them the results. So until they give the customer the results of their DNA, they won't book the revenue. So they hold it in deferred revenue, which is a liability on the balance sheet. And then once they actually provide the results of the test kit, then they move it out off of deferred revenue and onto the balance sheet as revenue. So they spent $3.5 million in PP&E in the second quarter of 2020 and $666,000 in the second quarter of 2021. So they don't have much in CapEx, because I wouldn't expect them to have too much in CapEx. It should be fairly limited. So the way I calculated their free cash flows is I just took operating cash flow minus CapEx. So that's just for one quarter. So I multiplied that by 4. Could HIMSS do this? Wait, HIMSS is they do the they don't do DNA testing, do they? All right, it's that's the Viagra. They sell Viagra. That's their main thing. I don't. When you say HIMSS, do what? The do DNA testing or supply information to the biopharmaceutical companies. So it is kind of hard looking at the data because it's not too reliable at this point. They're obviously losing money, and it takes time. So it's kind of a big guess on where the company's headed. It's not like when you look at like Amazon, it's kind of consistent, strong, positive. I mean, I guess anybody can do anything, but yeah, I don't think that this would be in their wheelhouse. They're just selling medicine, right? Do they actually make medicine, or they just sell it? Yeah, it sells medicine through. Yeah, I think it would be a pretty big jump for them to do this. So they raised 1.7 billion. See, I don't get that 1.7 billion, but didn't they receive 3 billion from the SPAC? Well, maybe this is as of June 30th. So maybe it doesn't show up on this. The 3.5 billion will probably show up on their 9/30 balance sheet. Does anybody know? Can anybody confirm Did 23andMe get 3.5 billion when they went public, or did they just get, a part of that? Okay. Let's look at a capital structure. They have 663 million of equity, 91 million of debt. So they're 88% equity, 12% debt. Their net debt is negative 679 million, so they could pay off all the debt with the cash on their balance sheet and still have 679 million of cash left over. I use their middle whack on Finbox, 8%. And that's the discount rate we're going to apply to the future cash flows. We estimated 6 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 6. That's 5 billion. We discounted those numbers back today using the weighted average cost of capital. We get a value of the company of 3.3 billion. We divide that by 400 million shares. I don't need to do it. We get a calculated stock price at 811. They're trading at 1172, so they're trading at a 44% premium. It's a sell according to the model. I'm losing a lot of people, so maybe this wasn't the best idea to do a live stream of the video when I prepare for it. So the way I calculated their future revenue, the analyst projection was for their revenue to increase 14.9%. So I increased their revenue 14.9%. That's not true. According to one of their presentations, they said their full year 2022 revenue should be 260 million. So I gave them the higher 260 million. And then I grew it 14.9% until 2024. And this is just a guess, but I grew it 50% after that for the next 3 years, because I do think the sale of all the data they have will be their biggest revenue generator. So I predict 1.2 billion of revenue by 2027. And I looked at some other companies in this industry, and it seems like the average company converts 23% of their revenue to free cash flow when I looked at other companies in this industry. So I multiplied their revenue by 23%. That's how I got the future free cash flows. And I figured it would be negative. Actually, I'm going to give them negative for another year. I don't think they'd get positive yet. So I think they'll have negative free cash flow up through 2024, and then they'll become positive for the first time in 2025. So if you think that they're going to do a lot better than what I'm saying, then your valuation will be higher than mine. But if you don't, then you also think the stock is overvalued. But of course, you can make money on a stock even if the company never makes money, if the market drives the price higher. Two analysts priced this stock, and the average price target was $12.50. So this is where the stock has been trading. When was it? In June. In June, the merger was completed. but I think it was around March it was announced. But it was really high here. They must have announced it because usually it trades at $10 for a while. So this is when the merger was completed. So the stock got the highest well before they actually acquired the company. This is probably when Branson's company announced they were looking into acquiring this 23andMe, and usually the price gets driven up, and then there's a big sell-off, and it comes way down. So it is coming down. I don't think it's a $5 billion company, but I could see it coming down to like $3 billion. That's just a guess. I don't own Alibaba. Yes, I think if you avoid SPACs entirely, I think you'll be better off. And in 10 years from now or 5 years from now, let's talk to see how accurate that is. I think you'd be better off just avoiding them entirely. So the stock has gone up 18% in the past 52 weeks, while the S&P is up 39%. It did get down to $7 at its low point, up to $18. And the stock is trading above its 50-day and 200-day moving average. It's a pretty active stock. Over 4 million shares have been traded for the past 10 days on average. There's 407 million shares outstanding. 63% are held by institutions, and 3% of the shares are shorted. I do want to buy Alibaba. I don't know. It's a little scary to buy Chinese stocks, but so if you put $10,000 into this company when it started trading, you'd pretty much be at $10,000 today. I guess I don't have to. The CEO of 23andMe is the biggest shareholder at 24%. She's a billionaire now. GlaxoSmithKline is the second biggest shareholder, then Fidelity, G Squared, and Sequoia. So let's look at their financial ratios. We can't look at the PE since they have negative net income. Price to sales is pretty bad at 20. So when a company has negative PE, you look to the price sales ratio, and that's stock price over sales per share. So investors are paying $20 for $1 revenue. So the stock is overvalued based off of the price sales ratio. But when a company has a really high price sales ratio, investors feel they're in growth mode. Or if that wasn't the case, no one would buy the stock if they had a high price of sales. Price to book of 7.2, which is on the higher side. They have a high current ratio and quick ratio. They have lots of cash, $770 million of cash. So it looks like they should have enough cash to get through the next. Let me. So it looks like they have enough cash to get through the next maybe 3 years before needing to raise more capital. They are burning through a lot of money. Negative 181 million of free cash flow. That's an estimate for 2021. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 6 companies in the same industry as me. And if me has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at the PE. Look at, in this industry, only one company has positive earnings. Every company besides Illumina has negative earnings. Because when the PE is negative, it's not applicable because you can't have a negative PE. Their price sales is actually better than average because a lot of these companies don't really have much sales. They're doing better on average in price to book. Everybody has a pretty high current ratio except Precipio. It's a really small company. ROE, everybody's negative except Illumina, the only company with positive earnings. They're low in debt and 5 billion market cap. But to summarize, I have them trading at a 50% premium. So it is a really innovative company, and they do something pretty different than companies. And although I think there might be competitors coming up, the fact that they have a pretty substantial size of the market so far, I think they should be a pretty strong company in future years. I do think it may come down a lot, and I think the potential for growth with selling their data, I think that's the biggest thing for this company. This is why I do the practice to get these things in my head so I know what to say. I kind of run out of ideas. So I rank their free cash flows 1 out of 10, their revenue 5 out of 10, and the ratio of 3 out of 10. Okay, does anybody have questions now that I'm done with the video? Any ideas I should add? Does anybody? Did anybody look at that stock I was talking about, FBRX? I hope I'm not wrong. I'm going to look dumb, and people are going to stop watching my videos if I keep making these. Either one, I guess for the video I was referring to, but this is okay. So Forte was trading. It was never trading this high. They did a 1-for-15 reverse stock split. This is after the split. So it was up there. It was like $40, maybe even over 40. And then on this date, the only drug that they were working on failed phase 2. So it's pretty much it's a done deal that when failing one of the phases in the drug discovery process, well, I don't know if it's always just a done deal for every company, but in this case, they said they're not moving forward with the drug. And that's the only drug they're working on. So the company, I mean, it's not going to go bankrupt because there's no debt. And in order to go bankrupt, the definition of bankruptcy is not being able to pay the interest on your debt. But so they have more cash on their balance sheet. So you can see the stock just kept coming down. Maybe I'm lucky. Somebody asked for this video, and the day they asked for it, I don't know if it had the exact low point, but it's pretty much the day they asked for the video. It was 271 when I started doing the video. I guess it hit 265. I guess 265 was the low. But I mean, I value it at about $4 just based on the cash on its balance sheet. Because if they just shut down the company, it's pre-revenue. If they just shut down a company today, that's $59 million of cash. That's due to us. We own the company. Like the CEO can't just say, okay, I'm taking $59 million. See ya. He can't just do that. I mean, he could pay himself a bonus and he gets a salary, but that money is due to us. So there's really no downside to investing in this company. Because when I invested in it, see, when I did the video, it was 38 million market cap. It was trading at 271. I got it at 290. Now it's up to 309. I mean, I'm not saying it's gonna be a $1 billion company, but there's really no downside risk. I don't see how you can lose any money. And they have seven patents. So there's value. Even if they didn't have anything, we do know they have enough cash, more than in the market cap. But they also have patents, and they have some information through going through the drug testing. But I don't know. Like, maybe I'm wrong. I mean, I'll learn a lot, but it just doesn't seem like you can't really lose anything from this investment. And you might stand to 2, 3, 4x your money. But this is how you learn. Like, if I didn't invest in this company, I probably wouldn't follow it much. Even if I did follow it, I probably wouldn't remember much that happened. But now, whatever the result is, I'm gonna remember it for the rest of my life because I have money on the line. And the more money you put on the line, the more you focus on it. OESX. Orion Energy Systems. What's the market cap? It's another small company. It's been around a while. Is this the same company? It's been around since 2008, or was it was it acquired or something? Did it acquire like a shell sometime? They have positive cash flow. That's good. They buy back stock. That's interesting. A company this size, they usually don't buy back stock. Revenue looks pretty good. The thing with these kind of penny stocks is that not many people know about them. Like it's not like see 100,000 trades a day. It's not like these big companies that like everybody knows about, and then lots of people are buying the stock and pushing the price around. That's the only thing I don't like about some of these smaller companies. PE ratio 4. Yeah, I mean it's pretty amazing. Yeah, a 4 PE ratio. That's it. Yeah, this doesn't seem like a risky, even for penny stock. It seems like there's not much downside, but it could take like a decade before you see big returns. Yeah, it moves fast in both directions. Exactly. But this is interesting. Electric Orion. I think I've heard of that. The thing with the FBRX is that it is a penny stock, but it's sometimes it was the same thing with Hertz. Remember when it filed bankruptcy? Then a lot of activity. So I think now that it hit the bottom, I think people are going to realize that there's a lot of value in the shell because they have no debt, so they can't go bankrupt. The worst case scenario is they sell the company, and you would definitely get a return on that because the cash alone is worth more than the company. You possibly make a 2-3x return if they sold the company. And the best situation would be if they started to develop another drug, because then people start buying the stock again. Like when they were in a drug development phase, people were willing to pay $30-$40 for the stock because they passed preclinical trial, then they passed phase 1. So as you get closer, it seems more likely that the company may get FDA approval. It's the same thing with like a company like Tesla or Amazon. They were losing money year after year, but people saw it getting closer to making money. And then once they made money, they were going to make a lot of money. Okay, only 3 people left, so I guess I'll end the call. It doesn't seem like there's much interest. Well, thanks for joining, whoever is still there. I guess you'll see the video in a few days of me once I do it. It'll be a lot cleaner and a lot less kind of stuttering as I'm trying to go through it. Okay. See you later.